Hello and welcome. In today's video, I'm going to show you how I use a specific method that helps forecast commercial real estate rents or asset prices. To help do this, I'm going to use very typical macroeconomic shock indicators and go through an example. Let's get straight into it. So what are we trying to forecast? And why does it matter to commercial real estate investors? Well, let's go through that now. So we're going to look at three major types of macroeconomic shocks that generally account for movement in this case, commercial real estate asset prices. It could be rental growth, it could be cap rates, income yields, or whatever it might be. So the three types of shocks we're going to look at, the first one is demand shock. Now, a shock is something that is a sudden impulse into an economy. For example, a demand shock might be, the UK suddenly deciding to build a new airport in a particular area. Now that's going to be good for that area. It will take a long time for the development to actually happen, to materialize. But the economy around that area, the increased jobs and prosperity, and people sort of coming backwards and forwards, doing business or holidays, whatever it might be. That's an example of demand shock, and that's good for the economy, and GDP will increase, etc. And that's an example of a demand shock. Supply shock is when generally something is in less supply. So, I mean, it could be actually in more supply, but let's just say we've generally seen around the world that, for example, if we have conflict, things like countries that produce oil, for example, we may not trade so much with them, or indeed at all. And the price of oil that makes raw materials and all sorts of goods is in less supply, and therefore we have to pay more. And that's sort of a negative shock for an economy. And a monetary shock is generally when central banks either ease the cost of borrowing or converse, and people either pay less or more for their mortgages and loans and all that type of thing. And that's an example of a monetary shock. So these three shocks are the sort of very sort of normal shocks that we see all the time in the macroeconomy, and these generally tend to have short, medium, or long-term effects on, for example, commercial real estate prices. So how am I going to measure these three shocks? So I use a technique called forecast error variance decompositions. Now, we just call them variance decompositions, and what this is it basically tells you the percentage contribution of each of the three types of shocks measured at the same time that accounts for the movement in, for example, an exchange rate, for example. Exporters want to know, say, if we have a big demand shock, for example, they want to know in 3, maybe 5 years' time, is that demand shock going to contribute a lot to the movement of the exchange rate? Is it going to be significant? Is it going to be more than a monetary shock that might have happened over that period of time? Who knows? So they want to know the contribution of each of those types of shocks that accounts for movements in the exchange rate. As exporters, they want to know these things. And we can measure these things over the short term, medium term, or long term. So here we are. This is Margaret, and she is a commercial real estate investor, and she would like to know the future of office rents in London, in the UK. Now, the economic conditions are this. So demand is improving, there's good job growth, GDP is looking good, and we're in sort of better prosperity than we have been recently. Unfortunately, supply is still restricted, with still conflicts around the world, all prices are going up, and there are fewer newer developments and a little bit of uncertainty. Having said that, the interest rates are declining in the UK. The Bank of England have seen that the conditions are now good and sufficient to be able to reduce rates, so people have a little bit more spending power, etc., and they can spend money on different things that they were ordinarily not able to up until sort of last year, the previous year. So what Margaret wants to know is, well, where are London commercial real estate rents heading? And from our VAR model, this could tell us what percentage of the rent price fluctuations come from demand shock, supply shock, and monetary factors. I'm just presenting here a visual of what this might look like. It could be after any length of time. I normally take sort of 1 to 10 years. This could be a short-term movement. So what this means is that 50% comes from the demand shock. That accounts for the movement in office London rents, 30% from the monetary shock, and 20% from the supply shock. So what does this mean? So if the historical data shows that demand shocks explain 50% of the movement in London rents, then we can say that a demand rebound today is a strong signal that rents could rise. Also, if the supply shock explains, say, 20% of the movement, then a squeeze might not affect rents so much in the short run. The monetary shocks explain, for example, 30%. So interest rates are falling, people are doing better, so this could drive up demand even further. Here's the interesting bit. I'm now going to go through an example that takes data. It's not actually real, it's not real data. This is data that's very similar to what we see, but I'm going to go through a numerical example just to show you how this actually turns out. So here we are. Now we can move to the actual calculation. So what I've got here is a data set. So I've got the year, London office rents, so that's the index of London office rents, GDP as a growth rate, and not an actual value in levels, the oil price, and the interest rate. And we can see here this goes from 2001 to 2024. Now, I'm going to use a system, for those who have seen previous videos, I sometimes use a system called eViews, which is a very powerful tool, very accurate, and it chucks out sort of numbers, and we can then interpret those numbers from the results. Now, let's just go and put these into eViews, just bear with me. So this is eViews. I'm going to create a brand new work file. We start from 2001, from 2024, I should say, and copy this in. Here we go. Now I need to run a quick regression. Now I'm going to estimate VAR. This is our vector auto regression, VAR. So what I'm going to do here is just put the variables in. Now, all I'm doing is running a regression that gives me something that I'll be able to then work out a forecast, an FEVD, a variance decomposition. So I'm going to take the log of office rent, and again, those of you who have seen videos before that I've produced, the logarithmic value is, we statisticians use that to be able to better explain economic trends and that type of thing. So we're going to take the GDP growth rate, we're going to take the log of oil, and notice that I haven't taken the log of GDP purely because it's in as a percentage, and you never take logs of a percentage. So this is oil, and the rate of interest, again the same. And this is our result. Now, this is not the actual result. What I'm now going to do is work out the variant decomposition, VD. We take our target variable, which is office rents. We want to know what the office rent market looks like and how it moves in relation to the three economic shocks. And this is our results. Now, what I'm going to do here is just to briefly just copy this and just put it into Excel just to show you what it looks like and explain it a little bit better. And I'm just going to move these out. So here, what does this actually mean? We can see here in this column here, period 1, 2, 3, and so on, down to 10. So these are the years. SE is a standard error. So this tells us how accurate the model is. If the lower the figure, the more accurate it is. So 0.03, it says it's very, very accurate. These variables here, London office rent, GDP, oil shock, and the monetary shock. Short term, sort of 1 to 3 years, medium term, 4 to 6 years. The long term, we generally say 7 to 10 years. After, let's just say, forecast horizon 3. So this is after the third year. What we're saying here is that when we are trying to look at the movement of office rent, 90% of it is down to the price, down to itself, whereas 3% of it is down to GDP shock, 4.6% of it is down to the oil shock, and 1.5% of it is down to the interest rate shock. But we can see here that the office rent itself is declining, and when we come to year 10, it's now overtaken by the oil shock. So what we're saying here, from year 10, most of the movement in London office rent price is down to the oil shock. Now we can interpret if that was a negative shock, if it's a positive shock. If it's a negative shock, does it move prices up? It depends on what your analysis says. If it's an oil shock, maybe the price of raw materials went up, etc. So the rents are going to go up, etc., etc. So we can possibly deduce that. And the interest rate only accounts for 11% of the movement in office rents. And that's generally how we interpret this. It's generally a composite decomposition, as it says, how much of this shock is attributable to itself, GDP, the oil shock, and the interest rate. If you add these up, they come to 100. So it's just generally 100%. So we can see that this generally does make sense. As far as sort of GDP is concerned, it does have a sort of gradual impact. Leases typically take 5 to 10 years to materialize. It takes time for businesses to expand offices, etc., after growth of a GDP shock, for example. So it does look very sort of typical to what we see. If GDP increases, then so office buildings develop. If they're developed quickly, rents may not rise as much. So, but if supply is restricted and there's demand side pressure, it might mean higher prices. Well, I hope you found that useful. I have left an expression of interest form in the link down below. If you found it useful, just put your name and email address, and I will let you know how we're getting on with more of these and the building of our platform. Also, I will send you an 80-page ebook entitled Building Wealth Through Commercial Real Estate. So I will see you again on the next one. Bye.